Hi, this is Chris German. Welcome back to the Apartment Dealer Show. With me today, I have Mr. Steve Hall. Now, any of you that are familiar with our educational events have seen Steve for over a decade now advise and educate owners on how to maximize profits and how to maximize their tax write-offs in terms of their multifamily ownership. Now, Steve unfortunately was not able to be with us at our recent event. He now is a Floridian, having moved from California to Florida, and our schedules ended up not lining up. But Steve was nice enough to come on our show today to address the top 10 questions that were submitted by landlords like you. We're going to dive into those today. And keep in mind, Steve is not an individual just giving you a textbook answer. Steve himself is a real estate investor and advises individuals of huge net worths. So he comes with that experience of helping people sort out through the weeds of, hey, how do you maximize your write-offs? How do you identify opportunities as a landlord? How do you pivot to profits, no matter the economy, the politics, or anything else that may be involved? So with that, help me welcome Mr. Stephen Hall. So Steve, welcome back to the show.
Thanks, Chris. I'm excited to be here.
And I can tell you the crowd was definitely disappointed. This is the first time you've missed one of our events, I think, in all 13 years we've been doing this now. But of course, you're in Florida, you're wearing many hats, but I can just tell you were missed. But I thank you for your time, and we're going to go through probably the top 10 questions that came in from those that had registered for the event. And so thank you for your time going through these.
Excited to be here.
So the first one, and we've heard this one before, but walk us through it again. What are the best or most profitable tax write-offs for multifamily owners?
Well, right now, great question, Chris. Right now, you still have bonus depreciation that's available. And what bonus depreciation is, it's where you could accelerate your depreciation on your rental properties and take it in the year you want to elect to deduct it. And that's called a cost segregation study. But the key is you need to retain a firm that specializes in cost segregation studies and complete that study no later than 12/31 of 2021 to get the deductions to accelerate the depreciation for 2021 to offset your categories of cash flow from other rental property activity.
Is that the only way to excel depreciation, or is it either that or 27 and a half years, one or the other?
That's correct. It could be 27 and a half years, and depending upon the life of equipment or a door, it could be 7 years. I'm just giving you hypothetical examples. But to accelerate the timeline from those generic 7-year, 27 and a half years, you could actually put together an engineering study. In the IRS terms, they call it a cost segregation study, that will articulate why we should shrink those timelines from 27 years to 3-year, 5-year, 7-year timelines. And because of bonus depreciation, they can accelerate that 7-year, 3-year, 5-year timeline to year 1.
And so I'm curious then, how does that affect you on a 1031 exchange? So if you bought $1 million property and you accelerate the depreciation only to find yourself in an exchange, 3 years down the road, do you see that as hindering you then, because now you don't have as much depreciation on the next property? Assumably you bought up in size, but because you accelerated on the first one, you don't have as much depreciation on the new property?
That's correct, because once you accelerate that depreciation, you lose the benefit from resetting the depreciation table for that specific property or the next property you defer your gain into. So you do lose it. So you want to be strategic on the year you utilize it. For example, if you jump a couple brackets from, let's say, the 12% bracket to the highest bracket of 40%, that would be a year to utilize the accelerated depreciation versus just taking it for the sake of accelerating write-offs at a low tax bracket of 12%, which could be that you're making as little as 80 grand a year. So you want to be strategic as far as when you deploy that strategy, so that way you don't shoot yourself in the foot in the future for depreciation purposes.
Got it. Now, of course, many investors are anxious given the climate of, take your pick right now, the economy, politics, and what have you. So, especially those that are in their golden years of investing, they're looking to sell. They're not excited about the capital gains though. And so oftentimes they'll look to, when they sell, provide private financing to the end buyer. How does capital gains work in that scenario?
Great question. So the way it works is if you've taken $100,000 in depreciation in previous years and you're going to carry the note, the government's going to have you pay taxes on the $100,000 in depreciation and what's called depreciation recapture. And as of right now, the recapture rate is 25% for the federal government. And if it's over $1 million gain, it could be as high as 13% for California. If it's under $1 million gain or total income for your household, it's 9.3% for now. That's number one. So for example, let's say you carry $500,000 note and you're going to accept 0 payments for 2021, and you're going to get your first payment of $100,000 in principal in 2022, and you have $100,000 in depreciation over the years on the building, you're still going to pay taxes on $100,000 for 2021 because of the depreciation. Then in 2022, you're going to have to pay taxes on the down payment of $100,000 that you receive in 2022. Now that down payment is going to be taxed based on the profit participation of the asset itself. So I'm going down the weeds here, but this is important. So let's say the building's worth $500,000 and you paid $250,000 for it. That means you made 50% margin in profit, because 500,000 minus 250 is 250. 250 divided by 500 is 50%. So 50% of that $100,000 that you receive in principal payments in 2022 will be subject to a capital gains tax. And that capital gains tax right now, as of November of right now, is 23.8% to the IRS and 9.3% for California if it's under $1 million, and 13.3% for California if it's over $1 million. And we should know more by the end of the year what those new capital gain rates are being proposed in Congress. But as of right now, it's 23.8 federal and as high as 13.3% California.
So that's a great segue to the next question. So the next question submitted by a viewer was, do you think Biden's capital gains reform and elimination of step-up basis will materialize? So maybe for the viewer who hasn't heard, maybe give them a little background on these two proposals and what they potentially could mean.
So our Congress, its proposals have been changing like the direction of the wind every day of the weather reports. One day they're talking about raising it to 30%. The next day they talk about 35%. The next day they talk about it being an ordinary income at 39%. As of right now, based on the wind, the direction of the wind, we're looking at potentially a 25% tax rate for the federal government, and California will stay the same at 9.3% California ordinary income under $1 million, and up to 13.3% over $1 million. That's phase one. But phase two, well, about Kris, you mentioned a very important piece that's called the step up and basis. So just to remind all the folks what that means, a step up and basis means that if your spouse passed away, right now under today's law, the IRS will allow you to reset the values of your properties to today's market value for capital gain purposes, meaning that if your spouse passes away today and you sell your apartment building tomorrow, you could potentially pay 0 tax, because the government will say your cost basis for that building is based on the value of the today if your spouse passed away today. What Biden's tax administration is proposing to do is to get rid of that rule. So let's say in 2022, they get rid of the law of a step up in basis. If your spouse passes away, you'll still have to pay capital gains on the cost basis you've inherited or you've had since the day you purchased the asset. That's a key fundamental difference. And Congress so far has been in agreement to make that change in the law. And that would make a big change. And we'll talk about during this interview, we'll talk more about the estate planning considerations and what that means to impact all of the landlords in the industry.
So to be clear, and again, these are just hypotheticals right now, right? Want to be clear, there's no law being signed, but the step up in basis, if they were to eliminate it and you have a couple and one passes, the other now is left the widow, they would pay capital gains on the 50% that was passed along to them, or it doesn't happen until the kids inherit the property?
No, it's typically you get a step up in basis when a widow passes away, or if you're an heir to mom and dad's estate, you get a step up. But under Biden's rules, regardless if you're a widow or you're a child receiving mom and dad's estate, they want to eliminate the step up in basis rule.
So, Steve, when it comes to 1031 exchange out of California, let's say an investor sells an apartment building in California, buys another apartment building in Texas. Then 15 years from now, they sell that building in Texas. How do the capital gains work? Do they just pay the Texas state capital gains, California's, both? How does it work?
Great question, Kris. Up until a couple of years ago, it did not matter. As the last few years, California now wants to track where you invested that money. So, for example, if you sell your fourplex in California and exchange it for a fourplex in Texas, California requires you to file what's called a Form 3840 every year. That form articulates how much potential capital gains you would have paid had you not done a 1031 exchange. And they want to make sure you continue to report that form every year to preserve the taxation on your California asset. If you fail to report that form, they'll automatically send you a tax bill for the tax you should have paid with penalties and interest in previous years.
When it comes to estate tax, this is a question we see a lot at our events as well. What is the current amount one can pass to their heirs without triggering the estate tax? And also, if you trigger the estate tax, then what's the percentage that you're going to pay?
Great question, Kris. The estate tax right now on a person's estate is any assets you own under $11.7 million is not subject to tax. However, that tax rate is going to accelerate from 18% rate up to 40%, anything above and beyond the $11,700,000 threshold. Under the proposed legislation right now in Congress, they want to cut that $11,700,000 number down to north of 5 million. They want to chop it down 50%. So all of you that are listening to this event today, do not hesitate to call your estate planning attorney today. If I can give everybody advice today, the number one action item is when you finish hearing and learning about this presentation, pick up the phone and call your living trust attorney. If you don't have one, give Steve Spurrier a call immediately so he can conduct some estate tax planning and living trust planning for your family's estate, because these laws could potentially change by the end of the year.
Wow. Now, Prop 19, is there a way to avoid the property value being reappraised so that the property taxes don't get stepped up?
That's a great question. Prop 13 was a significant change in the tax code. What they're saying is that if there's a parent-child transfer of an asset that's not your primary residence, or it's not going to be your child's primary residence, it will get reassessed. Now, there's a lot of confusion in this area because we're in a transition year from Prop 13 or Prop 6090 to Prop 19. There's a direct line the County of Los Angeles has that all of you can call for clarification for your specific matter and concerns dealing with Proposition 19. And Kris, can I give everybody that phone number?
Please.
Absolutely great. That phone number is 213-974-3441. Once again, it's 213-974-3441. Call that hotline and they'll walk you through how they assess Prop 19 with you to assist you to maximize the savings for your parcels.
Next question we have here, somewhat general, but this viewer is asking, what are the most important or relevant new tax laws coming out in 2022? So is there anything on the books that is going to make a sweeping change for landlords for next year?
The only sweeping change right now is if you pay California tax individually, you could deduct that California tax through an LLC pass-through and make it a deduction for your LLC for you individually. So in other words, California created a workaround for you to deduct your personal income tax. That's number one. So talk to your accountant immediately about how to prepay your tax before the 31st of December to get the write-off if you have positive cash flow. That's number one. Number two, 2022 coming up, they could potentially clip that estate ceiling from 11,700,000 to 5 million. So you need to conduct your estate planning strategies with your estate planner no later than December 31st to take advantage of the $11 million ceiling before the end of the year.
Now, I remember with the Trump tax plan, and again, I'm not playing, politics here, but with the Trump tax plan, and at that event we were at, there was a lot of good news for landlords. Hey, there's going to be these write-offs and so forth, especially when it came to corporations. So far, what I'm hearing for any proposed Biden tax plan is not good news for landlords. But to the point of the corporate tax, my understanding is they're looking to increase the corporate tax. So those, again, for those landlords that hold properties in LLCs, what's the noise around this?
That there's a lot of noise. Well put, Kris. The word noise is a fair statement because there's a lot of misinterpretation about what they're proposing. The reality is the corporate tax will affect 1% of the landlords out there. And they're talking about raising that corporate tax from 21% to 25%. So we're talking about a 4 percentage point increase that very few folks pay. That's number one. Number two, the noise has also been around the $600 reporting of bank accounts and the $10,000 reporting of bank accounts. I've received many inquiries from folks that are concerned about the government tracking every move of every checking account for every one of your bank accounts. And the reality is the government does that anyway. What's different is they want to shift the responsibility of monitoring from the government to the banks. They want the banks to be responsible to tell the government who's moving money from one account to another. Now, the difference is when they do that, the banks will typically send a 1099 to you individually saying money moved from account A to account B. And then it'll be your responsibility as a landlord to report to the government why you moved the money from point A to point B and why it's non-taxable. It's just going to create another regulatory burden for all of us landlords to communicate why funds are taxable or non-taxable based on the movement of funds from account A to account B.
And while we're talking about noise, and this isn't on the list, but I'll ask for personal reasons, I also understand they look to hire a whole bunch of IRS agents. There's some truth to this?
They have, but remember, a third of the workforce is retiring as well. So a third of the baby boomer workforce is retiring. Most of them are baby boomers, and they're retiring from the workforce because they get an incredible pension from the federal government, and they need to replace that aging workforce with a new workforce to replace those folks that are retiring. So they are hiring more agents, but these agents are going to be more computer driven and audit and scope and penalty driven versus verifying your numbers. And also there's been several press releases behind this, but the government wants to target the folks that make over $1 million a year and audit those filings heavily to verify their deductions versus the folks that make under $1 million a year. And that's all speculation at this point. We have not seen any data to reinforce who they're going to audit and who they're not going to audit yet.
Next question here. How long, and this is looking for your personal opinion, how long can this market sustain these excessively high prices?
As long as somebody's willing to pay those excessively high prices and the banks are willing to appraise buildings at those high prices and the banks are willing to lend money at those high prices. Where it's going to get a little unstable is when the banks start using stated income products on loans for issuing more debt instruments to the economy. That's when you'll see the beginning of the end. And I'm starting to see stated income loans with 10% down payments for homes right now, as an example. And I think we're 24 to 36 months away from prices changing. However, if the banks continue to issue more debt instruments with lower loan to down payment requirements as we go forward to the next 12 months, that timeline may shrink about how long that we might see these excessively high prices. But remember, majority of the deals that are being traded right now have large sums of down payments. For example, Kris, what percentage of your deal flow have a 30 or 40% down payment?
Right. So that's been the case for eons now. That's why even during the collapse of 2007, 8, and 9, you didn't see but a handful of multifamily buildings actually foreclosed on because landlords had a good amount of equity in them. Even today, you're still having to put, not because the banks require it, but just because of pricing, you're still having to put, say, 35, 40% down.
Right. So as long as landlords are willing to put 35, 40% down, we're going to continue to see these prices rise because and foreign investors have more faith in the U.S. financial system than their own financial system. So they really don't care about making a cash flow return on their property. They just want to preserve their family's legacy by having it in real estate in a country that's a lot more stable than their country they're coming from. And that's the biggest difference. And it's a foreign concept to a lot of us because we've been accustomed to such a stable financial system. But when you factor in what's going on around the world with the destabilization of the economies, you can see why we continue to see assets appreciate with these large sums of cash as down payments into the assets.
And I'm curious, as we look to the economy and we look here at home, of course, now you've made the move to Florida, but we look here at home in California, a lot of the chatter is, hey, individuals moving out of state, going to Arizona, Texas, Florida, for various reasons. I'm curious, now that you've been a Floridian for some time now, what the talk is about us Californians. In other words, people that are there now, maybe reasons why they've gone, or their perception of California, their perception of California politics. I'd be curious.
The perception of California politics is that California has turned into a very restrictive state with rights. For example, it's a foreign concept for Floridians to have to wear a mask in restaurants. And they don't even know, majority of the folks here don't even have a vaccine card. And the concept of having to carry a vaccine card to go to a grocery store or to go to a restaurant is a foreign concept. It just does not exist here in Florida. So folks see California as a very restrictive government that micromanages its population, whereas Florida has the opposite viewpoint. They want to give everyone the freedom of choice to do what they want. They respect any citizen that gets the vaccination, but they want to give everyone the freedom of choice of their personal choice of what they want to do. And that extends to landlords with rent control. There are areas in the state where rents are being increased by 25% per annum to the tenant. And local government supports the landlord to continue to improve that property. And local government has so far been supporting the landlord to evict the tenants that are not comfortable with those rental increases because of the population growth that this state has been enjoying.
Yeah. Sounds like capitalism at its best, right? I mean, freedom and free rights of property ownership and to do with your property. And yeah, a lot of things have changed there. Okay, moving on here, kind of within the same thread though, how will inflation impact the real estate market? So obviously, everything is going, we have this combined issue of everything is raising in price, whether it's gas prices, food, building materials, and the supply chain that's a disaster. So what do you make of this, and what do you see its impact on the real estate market?
If you're in a rent control area, it's an absolute disaster because you as a landlord are going to see an increase in labor costs, an increase in materials, and yet you cannot pass that cost of infrastructure to your tenant base. Whereas in other states that do not have rent control, they can simply increase their rents 25% to cover the cost of doing business. So inflation is going to be an interesting conversation from the standpoint of what's real growth versus what's inflationary growth. If you're in states that do not have rent control and you have the ability to raise your rents and keep your buildings 100% occupied, inflation is a great thing for you. But if you're in a state or a city that caps how much rent you can raise, how much of an increase you can mandate on your property, it's a disaster. In fact, there was a headline that in the state of Minnesota, they're proposing right now to have mandatory rent control statewide, which would sandwich the landlord, where the landlord would have a ceiling how much rent they could charge, and then they're going to be sandwiched with their margin because the cost of material and labor that you cannot control. So it's going to be an interesting environment to be a landlord in, because in some areas you're going to thrive and be very successful. In other areas, it's going to be margin control where you can still be successful, but if you're in a highly regulated environment, it could definitely minimize your profit margin.
Now, and I know going back at least a year and a half now at our educational events, you've been talking about inflation, talking about what about could we see hyperinflation, and talking about other countries that have gone through that challenge. What's your take on the inflation that we see now? Do you think it's long term? Do you think it continues to grow at a steady pace? Is it volatile for the economy?
I think here's where this country's at a crossroads. I hope inflation continues, and I hope that the millennials that are 88 million strong continue to spend money. As long as they continue to spend money, inflation will continue to grow, and we'll be able to outperform and outpace the cycles of inflation to get beyond this precarious area we are as a macro economy, economic environment. What we don't want is the economy to shut down and prices to go down. Because if prices go down, we're going to have deflation. And if we have deflation, we could paralyze the economy for 10 to 20 years, just like what happened in Japan. So we need to avoid Japan. We need to, at all costs, we need to avoid a Japan where if these assets that were always this high, and then after Japan slowed down, it stayed this low for 15 to 20 years. And then you have what's called a lost generation that never made any upward momentum in real wage growth or real asset appreciation growth. And that's deadlier. Deflation is deadlier component than inflation.
And at the event, Gil and Bruce had a conversation with respect to inflation, the government's policy on buying debt and so forth, and obviously they're tapering that now. What effect that will have on interest rates, and then of course whether they, Gil is of the mindset interest rates are likely to increase. Bruce makes the argument that the economy will not be able to sustain higher interest rates. If anything, we might see lower rates from where we are now just so that we can save the economy. What's your take? Do you think rates will increase or decrease? And what does that mean for the economy?
It doesn't matter. Here's why. Japan had 0% interest rates and they still went into deflation because their population did not spend money. It's simple. If you're 88 million millennials and these baby boomers stop spending money, this economy will turn into a Japan and we're stuck, even if we have 0% interest rates. Simple.
Yeah. If that's what it hinges on. Well, and if that's what it hinges on, just looking at the spending pattern of that generation, I don't think we have any worries then. Because if you look at even the additional monies that they were given during the pandemic, landlords, I had multiple landlords call me, Kris, now that they're giving away this free money, you can't believe the amount of boxes from tenants buying televisions and stereo equipment and all this stuff that's in the trash cans now that they never saw before. So they literally were taking government help that they probably should have put away in case of if things had got worse and went and just splurged. So my assumption would be they're going to spend.
I hope you're right. Because if they don't spend money, this country's in a world of hurt, just like what happened in Japan for the last 2 decades with deflation. Because Japan did everything they could. They injected money into the economy. They lowered their interest rate to 0%, and they could not get out of deflation.
No. Scary place. But again, just given the spending habits, which normally I would say are not a wise idea, given what you said, then I guess now it's spend, baby, spend, just to prevent us from going over the cliff. So
that's right. And also look at the landlords. How many of your clients do not want to keep money in the bank now because they're worried their dollar is going to shrink in value?
Yeah, it's going to burn. Right? Yeah, I mean, they tell you, Kris, it's going to burn up, so better put it in this, a tangible asset.
That's right. And that's incentivizing baby boomers that always have reserves at the bank. They're terrified to see that dollar shrink. So what are they doing? They're taking it out of the bank account and they're injecting it into the financial system. And that methodology of taking it out of cash in the bank and injecting it into the financial system is what's going to outgrow your asset base rather than keeping it in the bank. Because remember, there's many folks that's always, the slogan, cash is trash.
Mm-hmm.
Right? Cash is trash. When you look at the U.S. economy and the U.S. currency, it's garbage. It's going down. I mean, the price of milk has gone up 20% this year alone. Pizza boxes have went from $25 per batch to $95 in 1 year. You had a close to a 300% increase in paper goods. Cash is trash. So you're better off taking that cash out of the bank and buying assets. I'm not saying to buy any asset, but to be strategic and smart of where you deploy your capital.
Now, we'll definitely look forward to you being at our next event, which typically takes place somewhere around March, and we'll pull all the strings we need to have you to be a part of that event. But we're talking, that's a good 5 months from now. So any other last words of advice you could share with the landlords, as they consider their options, they consider what should they do with their portfolio until we meet again?
Get rid of any assets that are C-grade assets now while the banks continue to loan money. Get it into good quality areas and study your rent control laws and really ask yourself, do you want to be in an inflationary environment and keep your assets in a rent control environment where you do not have an inflationary hedge against raising rents? Because that rent control will minimize your ability to raise your rents while the government will continue to raise your property taxes. Your utilities will continue to raise utilities on your tenants, and the insurance premiums will continue to climb. Your labor costs are going to continue to climb, and your materials will continue to climb. So it's really important to be strategic of where you buy and how you buy and get that money to work. Because if we look at history of Japan and other countries, we're not going to be where we were 15 years ago as an economy. And we're at a crossroads. As long as our millennial generation, 88 million strong, spend money, we should be fine. If they don't spend money, we're going to have to revisit this conversation to see where we will end up in a decade.
And with that, Steve, we will thank you for your time. Thank you again, for answering these questions. Obviously, the tax questions are one of the two major categories that people look forward to as they engage our event. So thank you. Thank you again for donating your time here today.
Oh, you're very welcome, Kris. Thank you.
Well, there you have it. The top 10 questions most asked by landlords, answered by the expert himself, Mr. Stephen Hall. Be sure to like our show, subscribe to our channel. If you're a landlord, if you own multifamily properties, especially here in California, we continue to share real content. We continue to share those strategies that will make the difference in your profits. We continue to share the strategies that will make a difference as you're essentially competing against the state. Here you will learn the tactics that real landlords use to grow their portfolios, to expand their financial legacies, and to put their heirs in a better financial position down the road. I hope you found today's show informative. Kris German from the Apartment Dealer, and as always, wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. Till next time.